Hello, everyone. My name is Keegan Guy, and I need to unmute my mic when I get on a webinar. I'm the Marketing and Business Development Manager at Police Retirement Services. Just wanted to thank everyone for being here today for the Alternatives to the CalSavers Mandate webinar. I know there are such limited options when it comes to online webinars today, so I want to applaud you for choosing the right one. We're going to be discussing the CalSavers retirement program and what other options are out there. So you are in listen only mode right now. So if you have questions, please feel free to put them in the chat. We'll respond as quickly as we can during the webinar. And if we don't get back to you, we will get back to you within 24 hours. This webinar is for informational purposes only. It is not to be considered legal or tax advice. But if you'd like to get into specifics with your company's situation, we'd love to be a helpful resource for you. So feel free to reach out to me. We can schedule an appointment and go into further detail. So that is all the housekeeping I have for you. I'm going to turn it over to my colleague, Mike Rogers, so we can get things started. And Mike, take it away.
Well, thank you very much, Keegan. Perfect. So hopefully everybody can see that. Again, this is Mike Rogers with Police Retirement Services. We're going to talk a little bit about the mandate, which for most of you has either already happened or is about ready to happen. And then we're going to talk about some alternatives that you folks may have. So I will try to monitor the Q&A session as we go along. So if something pops up, by all means, feel free to type those in. If we don't get to them while we're going through them, we'll definitely get to them at the end. So again, the CalSavers mandate. Go. Trying to get to my next slide. There we go. This program rolled out. We're going to talk a little bit about the basics. We'll talk about what you have as a responsibility as an employer. And then we'll also talk about some of the options that we think might be more beneficial to you as the employer, right? So this bill rolled out. It was initially scheduled to go live in July 1st of 2019. When we put this slide deck together, say a year ago, there was about 9 states. There was 13 as of last week, and literally within the last few days, a 14th state has come in. So these are being run by the state. There is a couple of cities, for example, New York City is doing a mandate, and we expect to see more of this to the extent that at some point here in the very near future, this may be all 50 states, right? So the key thing about what the government was trying to do here was to get individuals to start saving for retirement, right? So if your employer does not offer a retirement plan, then it was up to you as the individual employee to go to an IRA, to do some sort of after-tax savings account. And what we're finding, or what the government has found, is if there's not a retirement plan, most folks weren't doing this. So they felt what would really be beneficial was to go ahead and have these be mandated. And the biggest question that probably comes up, or what we call downfall of this, is cannot have any employer contributions. So a lot of times, small employers say, I don't want to do a retirement plan if I have to do retirement contributions for my employees. What the state mandated plan says, you cannot do it even if you want to. So when we get to alternatives, we'll show you some ways where actually employer contributions can be very beneficial, right? So this came into effect. It was originally supposed to be in effect for employers that had more than 100 employees. That was supposed to be June 30 of 2020. Pandemic hit, so they gave you folks an extended deadline out to September 30th. And if you think about employers that would have more than 100 employees but not have a retirement plan, and think about demographics, what we found was these tended to be retail, high turnover, very young employees, where there wasn't a whole lot of demand for a retirement plan. This might be restaurants, again, a lot of turnover, casinos, things of that nature. If you're here in the Silicon Valley and you're a tech company with more than 100 employees, you've had a 401k plan from day one. It's just how it works, right? So the first mandate was September 30th. The over 50 employee mandate was last June. And then now the new deadline, which is the one coming up here at the end of this month, is if you have 5 or more employees. And so how do you determine how many employees you have? Well, one of the easiest things you can do is you can just look at your staffing. I have 6 people on payroll today. That means I have 5 or more. I need a plan. But what the state is doing is they're going back and looking at your DE9C form. So maybe you only have 4 people on payroll today, but within the last year you had 6 and 2 of them left. Technically, that means you're going to fall into that grouping. That means you have more than 5 employees. So just be a little careful there. The easiest thing to do is to just say how many people have been on payroll for the last 12 months. If that total number is 5 or more, you're falling into the new mandate, right? So again, so what happens? We get this question quite a bit. What if I have out-of-state employees, especially in this new dynamic of remote work? If you have employees in different states, those employees in those states are subject to those state rules. So for example, the latest one that just came out was the state of Connecticut. They're not tiering their system. They're just saying if you have 5 or more, you have to have a plan. So be very careful if you need some help with this. There are some good databases out there that will, we can help you with that to say, oh, I've got 4 employees in the state of Illinois. Does that mean I have to do something, right? So you're going to have to follow the rules for each city and each state. And the one that comes up frequently here is I've got some employees in Oregon. Oregon is one of the states that requires, doesn't matter how many employees you have, that you've got to, I believe their plan is called Oregon Saves. So you have to be a participant in that plan, right? So what happens? How do I become exempt? Well, every employer in California must register with CalSavers. And I put this in bold because this comes up quite a bit. If you're a cannabis corporation, well, technically you can't federally have a retirement plan. The state of California says you must. So don't just think because if you're cannabis or somehow in the cannabis industry that you're automatically exempt. You are not, right? So how do I get out of this? Well, if you have a 401k plan already, or maybe a profit sharing or a simple IRA, if you're a nonprofit, you have a 403b plan, all of those are exempt. So what you're going to do is you will register with CalSavers, and then you're going to turn around and say, I'm exempt for the following reason, and it will be, I have an existing retirement plan. So there is a whole process that goes around this exemption, which we'll cover right here. So how do you register? You're going to provide them company information, an EIN, and your employer tax account number for payroll. What they're going to do is they're going to send you back a registration code. We've seen this information come back 2 ways. We've seen it come back in a paper form, so something will get mailed to you. We've also seen emails where they'll send you something saying your code is the following, XYZ248. So you would actually go onto the CalSavers website. You already have your employer number that we talked about in step 1. You now have this registration code, so they know it's you. And then you will go out there and you're going to apply for the exemption by saying, we already have a retirement plan. So once you've done that, they will then take you off their list to follow up. And what I found that's been very interesting is they are following up by going to look at the tax forms, the form 5500. So if you're claiming the exemption to say you have a plan, they are following up because that information is public information. When you file that, it's not like the tax return you and I file on April 15th. It's just an informational return. I'm an employer. Here's how many employees I have. Here's a couple of features for my plan, how much money is in there. The government's just tracking that. They're going out and following up to make sure that you're filing those 5500s. So we have seen that for groups that have either claimed an exemption or failed to go out and go through, the government is coming back with notices to say, dear Mike Rogers, we don't see a tax form for you out there. You either need to sign up or you need to file your tax return. So be very careful when you're going through that you're actually doing what you need to do. So this is what we'll call the carrot approach, but then there's always the stick approach. What is the stick approach? Penalties, right? So they are being reasonable at the moment by saying, hey, we think you missed this deadline, which is a group we were working with last week, which they did. This was a more than 50 employee. However, we know a lot of stuff's been going on. So do one of two things. Either tell us you've got a plan up and running or you're going to, or hurry up and sign up with us. So they're being gentle at the moment. We expect that process to become a little bit more stick-based after this tax filing season. So it's a pretty onerous penalty. It's $250 per eligible employee. So the difference in, say, the CalSavers plan, and we'll talk about a 401k plan later, is you can exclude people under qualified retirement plans. The CalSaver makes no such exemption. So if you have 10 people on payroll and you fail to do this, you're going to get a penalty of 10 times 250. So you're going to have, $2,500. Then they're going to tell you you're out of compliance. And if you fail to update them or start a plan or join their plan, that penalty then bumps up. In addition, they're going to charge you another $500 per eligible employee. So you can see that, if you have 15, 20, 25 employees, it becomes significant. If you're a 50-person plan, that's a 25 grand penalty in year one. And it doesn't go away. You're going to get a subsequent penalty in future years if you fail to join the plan. So right now we've seen it be very carrot-based. Hey, we know you're busy. We've seen them starting to say, we're going to send penalty notices, so we know these are coming, right? So as much as everything else is going on, we know you're busy, just don't ignore it because the state is coming, right? So what happens for you as the employer? And we've had employers say, you know what, this makes the most sense for us today, which is fine. If that works, then you've got some responsibilities. So you have to go through that whole registration process that we talked about. But then you've got to send to the state all of your employee information: name, date of birth, date of hire, address, social security number, basically employee census. So you're going to send that to the state, and they have a template. It's an Excel template that you will upload. And then therefore they know that your employees are eligible for the plan so that they can reach out. And we'll talk a little bit about what the employees have to do, but for anybody that does not opt out of this plan, so this is you're automatically in unless they opt out. And you guys can all sit there today and you've got employees that don't pay attention to a single thing you send to them. So they'll ignore this and they'll get into the plan. Then you have to set up a payroll deduction. So the state's going to send you back and say, dear employer, please start Mike Rogers at 5% of pay and start withholding. So once you do that, then you've got to work out that mechanism for transferring that payroll money that you've withheld, and it has to be timely. And how are you going to get that money to the state and let them know? So there's a lot of responsibility that's going to fall on you, the employer. And the biggest one we see is technically you are not allowed to give the employees any advice, guidance. All you can do is point them to the CalSavers website. You can order some very generic pamphlet material that will talk about this concept and just say, here you go, have at it, folks. So the employees are kind of left on their own. And then anytime an employee makes an adjustment they log on, they send a form, they do something else to change that deferral amount, or maybe they say, I would like to stop, then you've got to deal with that inside payroll. And here's another little tricky one. So let's say I'm an employee and I don't pay any attention, and you start withholding 5% of pay from me. Next year, this program has what's built in an automatic increase. It's going to say, dear Mike, if you don't do something, we're going to move you from 5% to 6%. Then they're going to send that information to you, the employer, and you'll have to go into payroll and update that. So again, each and every pay period, if you're weekly, it's 4 times a month, or semi-monthly or bi-weekly, you're going to have to send the state all those contributions and the breakdown in employees so they know how to invest it. So every time you hire somebody, you have to send that information. And anytime somebody terminates, you need to update that because the employee will then have the option to move these dollars to another plan. So again, we feel that this program puts a lot of a lot of responsibility on you folks, the employer, to make this thing run properly. So what about the employee? Again, this is automatically from each paycheck, and the starting rate is 5%. So if you happen to be in one of those industries that has demographics where your folks are paycheck to paycheck, things are tight, they don't pay attention, and now all of a sudden their paycheck says, oops, I got 5% withheld, they're going to come to you. They're going to notice, as we call it, right? They're going to notice that something happened, and they typically get upset. It doesn't matter that you told them, that you sent all the materials, the state contacted them. They either paid attention or they didn't. And for those that don't pay attention and are in, don't forget you've got that 1% increase, and that goes each year until it hits 8%. So somebody says, hey, how do I opt out? You can go to the CalSavers website. So since you've uploaded my information, the state knows about me. So I will get information on how to log in. I'll go in and I'll say, no, I do not want to participate, so I can opt out. Maybe I don't have internet, so I can call. There's a 1-800 number. And then there's still the old archaic paper form. You can complete a form and you can mail that to the state. But keep in mind, there's a lag time for all of these other than the log in and change it. So maybe I meant to opt out, but I didn't do it. And now the first payroll happens and you have to withhold. So again, we find that can be a little problematic. And then the bigger one down here is all contributions for CalSavers are Roth. So when we do employee education meetings, I always tell people, hey, has anybody here heard of Roth? Somebody inevitably will say, oh yeah, I'm a big Van Halen fan, David Lee Roth, totally different. These contributions are after tax, which means when you withdraw the money out of these at the end, when you're retiring, the earnings are tax-free. So we like Roth. We like the tax-free part of it. However, you must be eligible to contribute to a Roth IRA. And so the problem there is, here again in the Bay Area, if you're in a tech company or something similar, if you make more than 129K, you're not eligible for a Roth. So we'll talk a little bit about what happens if your money goes in and you're not eligible. Employees don't like that. And if you're married, it's 204,000. So, maybe you work at a company and your compensation is 75 grand, but your spouse works somewhere else and they make 120. Oops, we got a problem, right? So Roth is great. There's nothing wrong with it, but inside a CalSavers, you just have to be very conscious of who's eligible to make that Roth contribution. And then secondly, the contribution limits are the same Roth IRA contribution. So the maximum contribution is $6,000. And if you happen to be over the age of 50 at any point during this year, so even if you're not 50 today, you can still contribute $1,000 as what they call catch-up contribution for this year. So you can see, and we'll talk a little bit later, these limits are significantly lower than what you as an employer could offer your own plan if you wanted to offer, right? So got employer responsibilities, we've got employee responsibilities. So what is our takeaway, right? Almost everybody today, 5 or more employees, you're going to have to register. There's pretty onerous penalties. The burden of the work is on you, the employer. And what we've seen so far is a lot of employee confusion because, again, for those of you that have had retirement plans in the past, there's usually a lot of support, whether that's enrollment booklets or one-on-one employee education sessions or group meetings. None of that can take place with CalSavers, right? So we turn around and we say, like the headline said, what are the alternatives, right? There are plenty of vendors out there that have been doing 401k and similar type plans for 30 plus years. You know, you guys have all probably been in one plan before. Somebody's had a Fidelity or Empower or Principal or Vanguard, Schwab, payroll companies, ADP, Paychecks. They all offer programs that have track records. There's tons of tools around employee education and resources for your employees that just the CalSavers just does not have, right? So what are some of the big differences, right? So we talked about those limits, 6,000 plus 1,000 catch up in the standalone versus a 401k or standalone plan. It's 20,500 plus another 6,500 for catch up. So 7,000 versus 27,000. So for owners, for business folks, you just think about if you had the cash flow capability and you could defer $27,000, that there's some significant tax savings there. Another one of the big ones that we see is that you can do exclusions, right? You can exclude to some degree part-time people. There's tricky wording we have to do for that, but maybe you've got union folks. You can exclude union. You can make people wait for up to 18 months to get into the plan. So if you're one of those businesses that has high turnover, CalSavers, you're going to be uploading data, and dealing with that turnover in a retirement plan. They may never become eligible, so they never become an issue, right? Versus CalSavers, everyone's in. If we call it, if you fog a mirror, if you have a pulse, you're in the plan, right? And then lastly, and we get this question a lot from small employers, what about employer contributions? Well, if you're a 5-life group and you're a profitable company, and maybe it's a husband and wife and a child, well, 3 out of the 5 people are family, we can structure employer contributions to benefit that group at a higher rate than the rank and file. So again, you're saving business taxes, you're saving personal taxes, and you can do what's called a vesting schedule. So just because you give employees money as a match or a profit sharing type contribution, you're not required to give it to them right away. You can make them stay for up to 6 years to get all of it. So you've got an employee retention tool. You've got a way of saying, hey, I know I've got turnover, but I'm trying to recruit, so I need to do a match or I need to do a profit sharing, but you don't have to give it away right away, right? And so we get a lot. What we find, especially here in the Valley, small startup tech firms do not match or give profit sharing contributions to the level of small employers because they're venture backed and they say, we don't want you spending the venture dollars on company contributions. You could argue they prefer to spend them on pet insurance and the foosball table and the free food. But they just don't like to fund employer contributions. So again, the big difference is those are flexible. We can skew them towards, key employees, and we can have a vesting schedule. In CalSavers, remember, there just can't be any because it's a Roth IRA. So there is no room for employer contributions there. Another biggie, tax credits. They are your friend, especially if you're a profitable business. Remember, a tax credit, whatever tax you owe, your business tax, which you and your CPA are trying to minimize, whatever tax you owe, a tax credit is a dollar for dollar reduction against tax owed. So the government said, we would like you to sponsor retirement plans. So they're going to let you get a tax credit for up to 50% of all the plan expenses to a maximum of $5,000. If you do automatic enrollment, which is similar to CalSavers, if you say, hey, you're in unless you opt out, they'll give you another $500 credit, right? So, and that credit is good for 3 years, years 1, 2, and 3. So we find if you're a small employer, and we hear it all the time, oh, 401k plans are too expensive. I'm like, well, we can get you a plan for roughly about $3,000. So half of that is a tax credit. So there's $1,500. The other $1,500 is tax deductible. And you, business owner, get to defer $27,000 out of your taxes. The plan is paid for in a heartbeat, right? There's some legislation going through right now that may make tax credits significantly higher than this and cover all of your expenses for small retirement plans. So again, we're happy to do the analysis, but the mantra that we've heard for years and years is, oh my gosh, I'm an 8-life group and a 401k plan is too expensive. It sure doesn't have to be. Pricing is in your favor. Tax credits are in your favor, tax deductions and tax savings as the owner of the firm, right? So kind of in summary, the way we see it, and again, we've had some employers just do CalSavers because they're like, you know what, it's just going to be easier for us. You've got a little bit of work, employer and employees. And don't forget, we had talked about that potential tax consequence. If you make a Roth contribution and you're not eligible and you get ready to go file your tax returns, you've got some issues. You've got some refunds that need to happen. You've got some earnings that have to come out that get penalized because what you have is an ineligible IRA contribution, right? And a lot of times, as much as we love employees to be proactive, we know there's plenty of people filing tax returns on April 10th. April 12th. And that's, when you're plugging this into your TurboTax or you're talking to your CPA, that's when those come out. The standalone plans, we like them. You got the much higher limits. You get your flexible options around eligibility for who's in and who's out, as well as employer contributions. Plus, we had talked about that ability to kind of change or benefit some of the key executives a little bit more around the employer contributions. So again, obviously a standalone plan isn't for everyone, just like CalSavers isn't. However, what we found is in most cases, if you look at it from kind of a global perspective, the standalone plans tend to work way better, right? So some contact information, if you folks have any questions around this, you want us to do a study, you want to do an evaluation, you have questions. Maybe you started CalSavers already and you're like, boy, I don't like it. That's okay. You're not required to continue with CalSavers. Conversely, if you start your own standalone plan and you determine it just doesn't work for you, you have the ability to terminate that plan and you can go back to CalSavers, right? So again, I'm going to take a quick look here in the chat bar. Somebody had said, will you get the slides? The answer is certainly yes. We'll make sure that those are available to everybody that's registered. I don't see. Oh, here was a question that came in. Are these contributions reported on the W-2? So if you're in CalSavers and you are doing a contribution, the answer is yes. That will show up on your W-2. There'll be a code that will indicate that these contributions are not tax. They weren't pre-tax. So if your income was 30,000 and you had a Roth contribution, your income's 30,000. If you did a $1,000 contribution, if you did $1,000 401k, your net income would be 29,000, and then that's what you would get taxed on. So again, some of the biggest benefits of the standalone plan is pre-tax versus Roth, right? Somebody said, does CalSavers provide us investment education? They do, by saying point the employees to our website, as well as they do have some like one-page brochure type stuff where they say, here's what you should do. But if your employees are like most everybody out there, if we give them a piece of paper, they're really not reading it. Unless it's hard to figure out how we're going to get them to read it. Here's a question. What do I do if I have a 401k plan, but many employees have never signed up? Do I go to CalSavers? The answer is no, you're not required to. They don't have to be in one or the other. Meaning if they don't sign up, but you're offering a plan, then that you've satisfied CalSavers. So we literally use this example. We had a group out about 11 employees. There was a husband-wife owner. We made it available. They were the only two that signed up. It's the perfect 401k plan. There was a match in there. They got all the contributions and none of the work. So that's a great question. Employees, as long as they're eligible for a 401k plan, that counts. You don't have to then go sign them up for CalSavers, right? It's a one or another. Another good question. How long does it take to set up a plan? If you're doing a standalone plan, the good news for small employers is when we meet, we're usually talking to you, the decision maker. We can have these up and running in under 30 days. So, for example, the group we met with last week, if we know we're going to have a plan effective in July, we can help you right now. Go to CalSavers and say, dear CalSavers, go through that registration process and tell them that we're going to have a plan. There's a technical reason we go back because we're actually making the plan effective January 1st of 2022. There's technical reasons why that happens, but that means you've met your requirement. So as long as you can get in touch with us before about midnight on June 30th, we'll be able to legally say, yes, you have a plan and we're good to go. Somebody says, well, what if I miss the deadline? Again, you can do nothing, and at some point they're going to get to you. At that point, you're begging for forgiveness, which so far has been relatively lenient. But if you miss it and you come in July, and you're like, oh my gosh, I missed this, we'll get a plan set up, and then we'll help you reach out proactively and say, hey guys, sorry, we forgot to communicate to you. We've got a plan in place. Here you go. So hopefully don't call me next June. If you call us here soon or in the next month or two, we'll be able to get you through the process. Somebody else said, can I do CalSavers and something for my regular employees and a standalone plan for myself? The answer is probably not. This is an either or, meaning that you're either in CalSavers or not. And if you are in CalSavers, it must include you as the employer. So kind of back to the person that asked the question earlier about what if people don't sign up. We can skew that 401k plan to benefit the key people a little bit more than the rank and file. But yeah, you can't do both. For anybody that did sign up, if you think of a question after the fact, you go back, you digest this, maybe you poke around on the CalSavers website. If you think of any questions, just forward them over. We'll be happy to answer them. Oh, here's one that came in. What types of investments does each program have? So CalSavers has a set list of funds. The state has contracted with State Street, which is a big giant mutual fund manager. to offer a set fund lineup for the plan. So you as the employer don't get to pick and choose what the menu is. You've gone to the restaurant and the restaurant says, here's our price fixed menu. Here you go. What happens? Why is the state doing this? Well, it's because we live in the wonderful state of California. The state is taking a little bit of money off the top versus standalone plans. We can go direct to investment groups like Vanguard, like Fidelity Index funds. We're able to go get institutionally priced funds that in many cases are less expensive than what can be offered through CalSavers. And you as the employer get to customize that list. So maybe we've got a really highly technical group of engineer folks and they want a complicated fund lineup. We can do that. Maybe you're a rank and file and you said, I would like to keep it simple. That's what we do. We help you with that whole process around the investments. All right. Well, again, we will make sure to circulate this. Keep that last slide. When you guys have it, you'll have the information for John and I. We're more than happy to help you folks. And we'll get these out and you guys have a great day.